While the majority of retail investors are blindly chasing green candles and dreaming of the next all-time high, a silent alarm is ringing in the deep institutional corridors of the market. Most of you are focused entirely on the potential peak of 2025, but you are completely ignoring the mathematical inevitability that follows. Smart money is not looking at today or even next month. They are looking at the liquidity vacuum that is historically scheduled to open up in 2026. If you are holding Bitcoin right now, believing that this time is different and that the cycle has been broken, you are exposing your portfolio to a level of risk that you likely do not understand. The data suggests that we are walking a tightrope between a supercycle and the most aggressive capital flush we have ever seen. Over the next few minutes, I am going to walk you through the exact on-chain metrics and macroeconomic indicators that point toward a potential crypto winter in 2026. I will prove to you why the 4-year cycle is still the dominant force in this asset class, regardless of what the mainstream media tells you. Let us get into the weeds. To understand the threat of 2026, we must first strip away the emotion and look at the cold, hard structure of the Bitcoin market. For the past decade, Bitcoin has adhered strictly to a 4-year cycle tied to the halving event. Historically, we see a supply shock, followed by a parabolic run-up lasting 12 to 18 months, and then a brutal correction that erases the majority of paper gains. The reality is that human psychology and liquidity cycles have not changed just because we now have Wall Street involved. If we look back at 2018, we saw a drawdown of over 80% from the highs. In 2022, we saw a similar structure, where leverage was flushed out of the system in a painful, year-long grind. The question you have to ask yourself is whether the introduction of the spot, exchange-traded fund has fundamentally altered this mechanics, or simply disguised it. Many analysts are arguing that the constant bid from issuers like BlackRock and Fidelity will prevent a deep bear market. However, this perspective is dangerously naive because it assumes that institutional inflows are permanent and price agnostic. The truth is that institutional capital is actually more mercenary than retail capital. These large players rebalance their portfolios based on risk-adjusted returns. And when the Federal Reserve eventually pivots back to a tighter monetary policy, that capital will flow out just as quickly as it flowed in. Let us look at the realized price data for short-term holders. Currently, the 30-day moving average of short-term holder supply is sitting at a profit margin that historically signals a local top is approaching within the next year. When the market reaches a state of euphoria, usually expected in late 2025, the smart money begins to distribute their coins to the latecomers. This distribution phase creates a divergence between price and momentum, which is the classic setup for a cycle reversal. We are already seeing early signs of this behavior in the ratio of long-term holder supply. Whales who accumulated Bitcoin at $16,000 are slowly starting to move coins onto exchanges as we creep higher. They're not selling everything, but they are preparing the liquidity to exit when the retail frenzy hits its peak. If this data is helping you stay ahead of the crowd and see the market clearly, feel free to join our inner circle by subscribing to the channel for more unbiased analysis. Now, we need to address the macroeconomic backdrop that will likely trigger the winter of 2026. The global liquidity cycle, which measures the amount of money central banks are pumping into the system, has a high correlation with Bitcoin price action. We are currently in an expansion phase, which is fueling the current bull run. However, central banks operate on cycles as well. And by 2026, the data suggests we will be entering a period of quantitative tightening, or at least a pause in liquidity injections. When the cost of capital increases, speculative assets are always the first to be sold. Here's why this matters to your personal strategy. If you believe that Bitcoin is going to go up in a straight line forever, you are essentially betting against the history of all financial markets. The concept of the left-translated cycle is also gaining traction among serious strategists. This theory suggests that because everyone knows the 4-year cycle exists, participants try to front-run the peak. If everyone tries to sell before the peak happens earlier than expected. Instead of a high in December 2025, we could see the cycle top out in mid-2025. This would mean the winter of 2026 actually begins in the 4th quarter of 2025, catching millions of investors off guard. We must also consider the mining dynamics that will occur 2 years after the halving. By 2026, the mining difficulty will likely be at an all-time high, squeezing the profit margins of inefficient miners. If the price of Bitcoin drops while the hash rate remains high, we trigger a minor capitulation event. Minor capitulation is often the catalyst that turns a normal correction into a deep bear market. Miners are forced to sell their treasury holdings to pay for electricity and hardware, adding massive sell pressure to an already weak market. We saw this happen in June of 2022, and the on-chain metrics indicate the conditions for a repeat performance are building up for the next cycle downturn. The leverage ratio in the derivatives market is another ticking time bomb. As the price appreciates, traders become overconfident and begin using excessive leverage to chase gains. Open interest on futures contracts is currently climbing to levels that are unsustainable in the long term. When the inevitable correction comes, it triggers a cascade of liquidations that forces the price down violently. This is the mechanism that clears the forest floor, burning away the dead wood so that the next cycle can begin. The winter of 2026 is not just a possibility. It is a structural necessity for the health of the network. Without these periods of contraction, the market cannot find a true fair value for the asset. However, there is a silver lining that makes 2026 different from 2018 or 2022. The floor price of Bitcoin has risen significantly with every cycle. In 2018, the floor was around $3,000. In 2022, the floor was around $15,000. For the 2026 winter, our models project a floor that is substantially higher, potentially in the range of $40,000 to $50,000. This means that while the percentage drop might be lower than previous cycles, the dollar value lost will be staggering for those who bought the top. The volatility is compressing, but it is certainly not disappearing. If you want to navigate these treacherous waters with professional guidance, consider turning on your notifications so you never miss a critical update when the market shifts. The influence of the exchange-traded fund issuers adds a layer of complexity to this downside protection. These funds act as a dampener on volatility because they hold assets in cold storage and do not trade with leverage. This suggests that while we will have a winter, it might not be the nuclear winter of 80% drawdowns we are used to. Instead, we might see a slow, bleeding grind sideways and down, which in many ways is more psychologically difficult to endure. Investors tend to lose more money in choppy, sideways markets than they do in violent crashes because they keep trying to catch the bottom. The psychological toll of a 2-year bear market causes retail investors to lose interest and sell at a loss right before the next cycle begins. This is exactly what the smart money is waiting for. They need you to capitulate in 2026 so they can reaccumulate your coins at a discount for the 2030 cycle. So, is the Bitcoin winter of 2026 real? The answer is an emphatic yes, but it will look different than you expect. It will likely be defined by a liquidity crunch, a minor shakeout, and a macroeconomic pivot. The playbook for you is simple but difficult to execute. You must have a defined exit strategy for the upcoming bull run peak. Do not let greed dictate your decisions when the relative strength index is flashing overbought on the monthly time frame. You need to take profits into stable assets when everyone else is calling for a supercycle. Then you must have the patience to sit on your hands for 12 to 18 months while the market corrects. Cash is a position. And in 2026, cash will likely be the best position to hold until the capitulation wick occurs. The reality is that markets transfer wealth from the impatient to the patient. If you respect the cycle, you can use the winter of 2026 to build generational wealth. If you ignore the cycle, you will likely become the exit liquidity for those who paid attention. Watch the 30-day moving averages, watch the minor reserves, and watch the Federal Reserve interest rate policy. These 3 indicators will give you the signal when the winter is approaching. Do not get intoxicated by the euphoria that is coming in the next 12 months. Stay sharp, trust the data, and prepare for the inevitable shift in the market tides. None of this is financial advice. I am simply reading the charts and the on-chain data as they appear today. Always do your own due diligence before making any investment decisions.